People are talking about 50-year mortgages. Yes, that's right. 50 years. That's almost half your entire life if you live by 100. And you know what? Some people even think that this will make the housing more affordable. But smaller payments can hide very big problems. Today, I'll break it down in super simple English because, as you can see, English is my second language. I'll show you the history of 30-year mortgage, how much more are you going to pay on a 50-year mortgage, and the last part, I'll talk about something outside the 30-year or 50-year mortgage that Donald Trump is about to release. And it could actually help the housing market. And because the topic is so dry, I'm gonna try to lighten up the mood as we go along. So, what is a 50-year mortgage? A 50-year mortgage is basically a longer payment plan. However, you're gonna have to be paying a little bit lower than a 30-year mortgage. But the truth is, you actually pay a lot more as a whole when you do the 50-year mortgage. And that, my friends, is something that people miss. Some experts already think that this is too risky because you're delaying the pain and later on, you're actually gonna be hurt a lot more. I'll give you a short history about the 30-year mortgage. After the Great Depression, people lost homes because the loans were too short and it's too hard to pay. So, what did the government do? They created the 30-year mortgage plan. It's a little bit more longer, but you pay a little bit less. And the good thing about this is it's not 50 years, so you could definitely pay it off. It was normalized because it helped families buy homes, and the predictability of home ownership was a lot more stable. So let's do a basic math. 30-year mortgage versus 50 years. We're going to base it on a $400,000 house. As you can see here, for a 30-year mortgage, if you purchase a $400,000 property, you're going to be paying a monthly payment of $2,398 per month. And after 30 years, you would have paid in total the amount of $863,353. That means the total interest that you've paid would have been $463,353. Now let's compare that with 50-year mortgage based on $400,000 property purchase. Your monthly payment would be $2,106 per month. That means the total interest that you paid over the 50 years is $863,371. So, we've already established the difference is that you're paying $400,000 more on your property. So yes, the monthly payment is lower by $292 per month, but you end up paying $400,000 in interest. That's like paying two houses just to get one. Imagine telling your kids, sorry, I can't leave you any inheritance because I'm still paying for the kitchen. So the way the mortgage works is the first few years of your mortgage is basically you paying the interest to the bank. So as you can see here in this table, your equity after 10 years on a 30-year mortgage is at $65,000. But if you pay a 50-year mortgage, your equity is actually just $10,000 based on a $400,000 property. So after paying for 10 years, you'd own almost nothing on the 50-year mortgage. It's like running in a treadmill. You're moving, but you're not actually going anywhere. So why is this dangerous? Debt for 50 years means you're tied to your loan for your whole life. It means there's no flexibility. What if you lose your job? What if you have to move? What if you have a big plan that came in your way? Life always happens. But when you're tied to this kind of mortgage, there's little to no breathing room. You also build wealth a lot more slower. You can't save and you invest a lot slower. And the problem is, if you have to sell your property on a downturn of the market cycle, then you might even be owing the bank a lot more than what you borrowed. So, what are the market reactions on this 50-year mortgage? Experts say that 50-year mortgages can increase the home prices. Why? Because people can increase the prices of their homes if there's a lot more demand in the market. And what drives the demand? The ability for buyers to buy properties that are way affordable in their budget, even though The truth is, they can't actually afford it. It's all just inflated numbers based on the banker's will. So the buyers think that the loan helps, but the truth is, it actually just pushes the prices higher and makes it more unaffordable. So why did they do this? What's the state of the US housing market? Right now, mortgage rates are still higher compared to a few years ago. Home prices is high in many places because supply is low and buyers are struggling. A 50-year mortgage won't fix this, but it will allow you to borrow more, which increases the prices. So here's a forecast of what will happen if 50-year loans come to place. As you can see in this table, if 50-year mortgage spreads, then the monthly payment goes down, lifetime interest goes way up, home prices climb even higher, people stay in debt most of their lives, market risk increases, and wealth grows a lot more slower. This is like spreading the pizza so thin that you can see the table underneath it. It looks big, but it's not real food, and you'll end up a lot more hungry. And here's something new that they're talking about that might actually help. What is portable mortgage? Now, there's an idea floating around in Washington. Portable mortgages sounds fancy, right? Like your loan has wheels and follows you everywhere. This is what portable mortgages means. If you move homes, you can take your mortgage with you. It means it helps people avoid higher interest rates if they've already locked in a more preferable one. So instead of taking a new loan, you're actually keeping the old one. And I know that for countries such as Australia, where I'm at, you only get to fix your home loans with 5-year interest rates. But in America, the weird thing is they can actually do 30-year fixed rates. I wonder why the great financial crisis happened. It's like it's never a bad idea to lock in. People can actually lock in 2% interest rates. You'd think, how can the bank make money? So here's a summary of portable mortgage. Portable mortgage equals keep your old loan plus move into a new home. Same interest rate, same remaining balance, new property. Why is this being talked about right now? As I've mentioned earlier, in US, the interest rates are quite high. People don't want to move and lose their low interest rates, so the market is frozen. A portable mortgage can help people buy and sell again. So it looks like a solution. But here's the problem. Why portable mortgages won't fix the problem. It doesn't lower home prices. It doesn't increase the supply. It only helps the people who already own a home. First home buyers still won't be able to buy a property, and the banks might just increase their fees to cover their losses. Portable mortgages are like moving your old couch. It helps make it feel like home, but the rent is still too expensive. So here's the lesson. Big new mortgages sounds exciting, but it doesn't actually help the problem. Home costs too much, and wages don't keep up. A 50-year mortgage makes you pay more. A portable mortgage only helps the ones who already own a home, and both ideas really ignore the issue. But if you've learned anything from this video, all I would really advise is take caution and please try not to take the 50-year loan. So if you like this video, please like and subscribe so that we can continue making videos like this, and I'll see you next time.